Hello, everyone, and welcome back for another Indie Wealth Monthly Market Recap. As always, I'm your host, Nathan Zimmerman, and today we'll be reviewing a fantastic month of April for the stock market and discuss why, in the face of all the geopolitical turmoil, stocks were able to rally. Now, in this first chart, you can see the year-to-date performance of all of the subsectors of the S&P 500. The S&P 500 index overall is shown here in blue. We see that the overall index is now up 5% for the year after stocks rallied more than 10% in April, and that's one of the better one-month returns you're ever going to see. Now, if you recall, when I showed this chart just a month ago, the S&P 500 was actually down by about 4% year-to-date. We had just experienced a pretty significant correction as the war in Iran was in full swing and gas prices were spiking, and people were very pessimistic about the prospects for the market going forward. But at that same time, I told you not to focus on geopolitical headlines or scary headlines that move the markets in the short term, because at the end of the day, the stock market will tend to follow the trajectory of corporate earnings, and earnings were still expected to be quite strong despite all of the geopolitical noise. Well, we're starting to see just how strong those earnings truly were. Now, this next chart shows us the total earnings growth for the companies that make up the S&P 500 index, which is my favorite benchmark for the overall U.S. stock market. You can see very clearly that earnings growth has really accelerated in recent years, and it is this growth in earnings that has kept me quite optimistic on the stock market despite all of the background noise. History shows us that the stock market will tend to follow the earnings, and this next chart I'm going to show you will prove it. Now, this next chart shows us the earnings growth from the last chart in light blue alongside the actual S&P 500 index performance in dark blue. Over the long run, the stock market tends to follow earnings. So if earnings are rising, investors are willing to pay more per share for stocks. And right now, earnings are certainly on the rise. Coming into the quarter, Wall Street analysts had predicted that corporate earnings from the first 3 months of 2026 would grow by about 13% year over year. But now that we're 2/3 of the way through earnings reporting season, S&P 500 earnings are actually on pace to double that estimate at 27% year over year growth. That would be the highest growth rate we've seen in 5 years. Now, one of the more remarkable stories from the first quarter is the earnings growth rate for the largest companies in the stock market, the so-called Magnificent Seven, which is a nickname given collectively to Microsoft, Google, Meta, Apple, Nvidia, Amazon, and Tesla, is on pace to deliver earnings growth year over year of 61%. Yes, you heard that correctly, 61% earnings growth. Now, analysts had expected that group to show about 22% earnings growth, so the biggest and best companies in the world are delivering almost triple the earnings that Wall Street had expected. So given all of this information, you can see why the markets rebounded so strongly in April. Lots of things can move markets over the short term, but over the long term, as I've said again and again, prices tend to follow earnings. So that's going to be it for today. I'll be back with a written update in a couple of weeks. In the meantime, please share this video with any friends or family that you think may find them useful. I'll also post this to our Indie Wealth Advisors Facebook page, so anyone who shares the video from our Facebook page will be entered into a drawing to win their choice of one of our Indie Wealth hats or an insulated Indie Wealth mug. So if you follow us on Facebook, please share this video. Thank you.